In this presentation, we will enter an adjusting entry related to breaking out the short-term and long-term portion of an installment note. In order to do this, we will be taking a look at an amortization schedule. We will make this adjustment into QuickBooks Pro 2020, QuickBooks Desktop 2020. Here we are in our Get Great Guitars file. We got the open windows opened. You can open the open windows by selecting the view dropdown and then selecting the open windows list. We're going to be breaking out the short-term and long-term portion of a long-term loan. In order to think about that, let's first take a look at our report, the report of the balance sheet, by selecting the reports dropdown up top. Go into the company and financial, scrolling down to the balance sheet standard. Within the balance sheet standard, we're going to change the dates. We're going to do that up top in the customized reports. Within customized reports, we're going to change the dates from 01/01/20 to 02/29/20. That's January through February 29th, 2020, and then say OK. Here is our information. You'll recall last time that we adjusted from the long-term to short-term portion, the amount from a loan. And you'll recall that this loan payable had two loans involved in it, those two loans being supported by supporting schedules, a long-term loan supported by this amortization schedule, and a short-term loan here supported by this schedule. The short-term loan was all short-term, therefore we broke it out and put the short-term loan up top, up here. We're left then with the long-term loan. And this is usually the more complicated type of loan. You'll recall that usually most loans are set up so that the payments that we make are standardized. Because the payments we make are standardized, there's a variance in the principal and interest, which is a little bit confusing. And we then have a short-term and long-term portion. You'll recall that the short-term portion represents, or current liabilities are, those liabilities that are going to be having to be paid within a year's time period. So there's like an arbitrary cutoff date, a year's time period, short-term, anything else long-term. Well, what happens with this loan where we pay monthly? There's going to be part of it that's short-term, part of it that's long-term. For this reason, we don't typically break out the short and long-term when we set the loan up. We may have been able to do that with this one. We could have just put this in the short term and saved us a little bit of effort at the end of the time period. But we wanted to put all loans in the one loan account. But with the long-term loans, we don't do that because it's going to be too tedious. Every time we make a payment, we're not going to count out 12 payments up and then make the short-term portion. What we will do is make that adjustment periodically, typically during the adjusting process, during the cutoff date of the end of the month or the end of the year. So we're going to make it right as of 9/29, the end of the month of February, when we're actually going to be printing the reports, theoretically giving them to somebody. So let's go down and look at the amortization schedule. To do this, you have to have an amortization schedule to be able to break out the proper short-term and long-term portion. You may go, well, why would I need an amortization schedule? I know the payments. They're at the $1,357. I know the outstanding amount, and I know 12 months is how many months are out. So you would think then we could just take this 1,359 times 12. There's the current portion. And that is going to be the current portion that we will be paying, but it's not the current portion of the loan because it also includes interest. Now, you might say, well, why does that matter? I know I'm going to have to pay the interest too within the next 12 months. But the interest is kind of like what the same thing that you would have on renting. If you were to rent an office building, even though you know you're going to be paying the rent for the next 12 months, you don't put it on the books as a liability now. Why? Because you haven't lived in the place. You don't owe the rent until you've actually incurred it, until you've used the facilities. And the same is true with the money. That we've rented money, in essence. So we can't record the interest now because we don't record the interest, the amount of rent on the money, until we have actually used the money. So the time has to have passed that we have been using the money in order for us to owe rent on it. So therefore, we have to take out basically the interest portion. And you might say, well, that shouldn't be too tough, but it's a little bit more complicated because, of course, by fixing the amount that we owe, we have varied the interest and principal portions of that payment that we will be making from period to period. So that's going to be the problem that we'll be having to deal with. So here's going to be our table. We're going to say here, is going to be the amount that we owe. We started off with a $72,000 loan, and we had two payments. These two payments, we're now left with the $69,873 on our amortization schedule. That then matching what is in our balance here, the $69,878, and over here we have the $69,878. So now we need to break out of that what's going to be the current portion. So we need to not take the payments then, we need to take the principal. We need to say 12 payments down of the principal. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So I'm going to highlight this section, make it green, let's say. I'm going to right click on it and make that green. So, and there's going to be the next 12 payments. So then if I sum that up, if I say this equals the sum of these 12 payments, that then is going to be the current portion. So then the long-term portion is going to be the difference, of course, between what we currently have on the books, $69,878, minus the $13,109, which is going to be, of course, what we'll be left with after that point in time. So this is going to be the current portion. This will be the long-term portion. This is what we have now. This will be the current. This will be long-term. And so let's go ahead and center that, and I'll make this one green. So that's going to be the current and long-term portion. So then our journal entry, we know that this is the amount that's in the long-term payable. We need to make it go down by the $13,109, which will leave us with this amount in the long-term payable and put this amount in the current portion. So then if we go to the QuickBooks then, we could do that with journal entries. That would be the traditional fashion. We would go to the company down here. We would go to the make journal entries. We then see the debits and credits for it. I'm going to use the registers because there's only 2 accounts involved. Therefore, it is something that we can use the registers for. We could use either register we want, either the loan payable current or the loan payable that would be long-term, because they are both balance sheet accounts. I'm going to go ahead and use the long-term one. So just remember which one we are in. Lists, we're going to go to the chart of accounts and we're going to scroll down and we're looking at the loan payable. We're in the long term. So I'm going to go ahead and double click on that. We have our register then. Here is our register with increases and decreases. We want this as of the end of the month. So there is the end of the month. We want to have a decrease of the $13,109. So we're going to have a decrease here of $13,109. The other side then going as it did before to the loan payable current portion. Loan payable current portion. And so we probably want to put the same kind of note here, adjusting, let's just say adjust entry, break out short-term portion. Short-term portion. All right. So there we have it, recording that out. If I close this back out, and I close this back out, then we're back on the balance sheet. Then we're left in the loan payable. This is the long-term side of things with the $56,770. So that matches. It's $1 off because of rounding. So $56,769. And then we got the short-term portion up here, $18,109. And that's going to match out here. The short-term being you recall we have the 13 plus the 5,000 of the short-term loan, and that's the 18,109. So in other words, if we double click on this item, we then see that we have the 5,000 short-term loan and then the 13,109, which is the amount that we just allocated for the long-term loan, giving us the 18,109. If we were to double click on the 13,109, we get that back to our register. If we double click on the journal, we get to our debits and credits. Closing that back out, closing this back out, closing this back out. Then if we go to the long-term portion, the 56,769, double click on that, and we were to see there's the 13,109, there's the journal entry, double clicking on that. Here's our journal entry indicator, double clicking on that. There are our debits and credits. Closing this back out, closing this back out, closing this back out. Now, you'll note that one other thing that we did do during this process, we did record the interest. You'll recall that we recorded the interest as we entered this data into the system. It might be the case that we, as the bookkeeper, might work with a CPA that will make adjustments at the end of the year or the end of the month, a CPA or another accountant that might help us out with it. And if that is indeed the case, it might be good for us to set up a system and just say, hey, look, we're just going to make these payments to go against the principal portion. And we would like you then to make the amortization schedule if we don't have one based on the loan terms up top, and then make the adjustments breaking out the portion that is interest and principal at the end of the month. And that could be a good system to use. Then they can make the amortization schedule. It makes the data input very easy. And then at the end of the month, we just simply take the amortization schedule, not only break out the interest and principal portion, however, and also break out the interest to the proper account too. So that would mean that, in essence, we would first have to think about what would be the principal balance. We'd have to make the adjustment to the $69,878 to adjust for the interest that had been recorded or not been included in the entries when we made the payments. Then we can do the breakout of the short-term and long-term portion. That's a pretty nice system. I've worked with that system with people, and it works well. So now let's go back to QuickBooks here, and let's take a look at the trial balance to see where we stand at this point in time. We're going to go to the reports. We're going to go to the accounting and taxes and trial balance up top. We'll change the dates then to 01/01/20 to 02/28/20. Here are our numbers. You could then take a look at these, see if they tie out to where you are at. If they do, great. If they do not, check the dates. Use the auto zoom. Fix it if you can. Great practice to do so. If you would like to push forward anyways and there's a problem, we will be providing the backup files. You can restore the backup files and start the problem wherever you choose.